Welcome, everyone. It's time for an exclusive episode. We're going to be going over a bunch of stuff. I have a lot of things to talk about. It's been a crazy, busy past couple of weeks. We haven't had a little check-in video, an exclusive for some time, and the market's going crazy. What started off as seemingly a very niche sell-off, just with SaaS companies, has broadened from SaaS to like financial and data companies. It broadened from that to CapEx-heavy companies. Now it's just companies. Companies are selling off. Lots of stocks are going down. We're going to talk about it. We're going to talk about my portfolio. We're going to talk about Netflix. We're going to talk about Meta. We'll talk a little bit about Salesforce, and we'll talk about Bill Ackman. We'll go over these AI videos that look real, that cause Netflix is selling off today because of them, I believe. Netflix has a lot of pressures. It's down like 4 to 5% today. And we're going to go over all of it. This is going to be a fun video. We'll also answer some of your questions in the AMA. I have the Discord. I'll be going over just some of your thoughts, and we'll be discussing it. So I don't know how long this will be, but we have a lot to get into. And let's go ahead and just get started. Now, first of all, I just want to say thanks to all of you. And I share some appreciation. When I looked over the Discord this morning and I saw the market and how things are going, the market's the pits. It's really the worst right now. All these different companies are selling off somewhat indiscriminately. Lots of people are beat down in their positions, and there's lots of people in red positions today, just buying dips, and they seemingly go down more every single day. And during time periods like that, it plays mental games. It's difficult mentally for most of us to see your money evaporating every day. And that can cause people to get snippy, get a little snarky. It can cause people to get a little, have some angst and have some contention and disagreement and doubt and hostility and arguments. In some cases, that's what happens. But I'm not seeing a lot of that on the Discord. I'm not seeing a lot of people beat each other down and try to, oh, you invested in that one. Didn't you see that coming? You really thought that this company was going to do that, right? All those type of historical looking, snarky type of comments, I'm not seeing those. And so it's really cool to see a community with thousands of investors. And at least from my perspective, what I'm looking at, I don't see a lot of people, kind of beating each other down or doing anything too negative. What I do see is a lot of, questions and thoughts. There's a lot more activity. There's a lot of people that are, having fun with this, kind of sharing their thoughts on it. Lots of dip buying. And overall, I like that. I like the discussions. I like the constructive criticisms. And I also like, I like disagreement. So if you disagree on something, that's fine. But as long as it's in a constructive way, where it seems like you're trying to help someone that you're disagreeing with, not in a snide way or an undercutting way or, a condescending way, but if you're genuinely just disagreeing with someone, then you can share a different opinion and say, this is the way that you see it. And I think all of that's great. And I see a lot of that. So I just wanted to express some appreciation. I think the community is awesome here. We have a lot of cool people. I'm always learning things, asking questions. I get entirely different perspectives on so many of my different stocks, and it allows me to constantly reanalyze my positions. And in some cases, it does change my opinion on things, I think, for the better. So that's cool, and I want to keep that up. So keep doing that in the community. Other than that, we had news that Bill Ackman bought into Meta. Now, I want to go over just my thoughts on when you get validation on an investment. Like if someone that you look up to or someone that's big or smart buys into a company you hold. I think it's cool. I do. Like I'd be lying if I said that I didn't think it's cool, that I independently did research on Meta. I looked at the situation. I thought it was a really good buy. I looked at the moat, the threat level to AI, the returns from CapEx going forward, the increasing of moat that I believe is happening. And I did all that research. And then I had a level of conviction to buy heavily into the stock and make it a large position very quickly. And then doing that in and of myself, I feel fine. I feel confident in myself. I have a level of self-confidence that makes me willing to do stuff like that. But then seeing someone else validate it, like a big-time investor that has a team, that has resources, that has a hedge fund, that has very limited holdings, he has like 7, 8 holdings, to put 10% of his capital in that one company that you just had done research on is a really cool feeling. Like I'd be lying if I said it wasn't a cool feeling. Like just having a big time investor this is the stock to buy, giving your stamp of approval. And then him to outline all these great things that reinforce exactly what you've been saying about a company is also a great feeling. So seeing the list of it and him saying, obviously the CapEx is showing great returns already. Obviously, Meta has a lot of financial flexibility with their core business. It's trading at a low valuation relative to other companies that are growing the same. On and on and on. It's all the points I've been making. But he just reinforced and revalidated them. So I like that. It does make me feel good. It's always a fun thing to celebrate if a big time investor bought into it. Like I think it'd be cool if I don't think it's going to happen, but I think it would be cool if other super investors are buying into it as well. Having said that, it's not a core part of it's not any part of my thesis, not even a core part. Bill Ackman buying or not buying a stock is not a part of my thesis, and it never will be. He also bought into Uber, and I didn't buy that one. He also bought into Nike. I didn't buy that one. Amazon, which he owns, I owned before him. What is the other one there? Meta, I owned before it came public that he owned it. So he technically bought it before me, but I didn't know he was buying it when I was buying it. So, I didn't see him buying it at the time. And then there's Google. Google I owned before Bill Ackman as well. I had it as a position before Bill Ackman. So I'm not, and then Netflix, and this is why I don't put any of my thesis on people like Bill Ackman. I also thought it was awesome. In fact, it was validating when I where I was holding Netflix and Bill Ackman bought into it. I was like, finally, someone sees the big picture here. Someone agrees with me on the future of Netflix. It was almost a relief. Like I wasn't just on my own trying to say that the stock was great. Now I had a big time investor giving the stamp of approval. Bill Ackman came in and he said, hey, Joseph, you're right to be holding Netflix here. Look at all the great stuff about this company when he bought into Netflix. Then Netflix lost subscribers. And within 3 months, Bill Ackman's like, nope, I'm out. The company's not predictable. I have no clue where it's going. It's probably a great company. It'll probably do okay, but I'm out. And he sold the whole position at a $300 million loss. And there I am thinking, dang, I was excited when he originally bought into it, but now he's just sold out of it at a lower price. And here I am just bag holding this company. And it felt terrible. At that time, though, you can call it hubris or overconfidence or whatever, but I don't believe it was overconfidence at all. My thought process was at the time, the Netflix was so darn cheap that what's the worst that could happen? It could get even cheaper. It could go from a 12 PE ratio to like an 8. The damage had been done in my mind. It was already priced for extreme despair. It was priced for getting clouded out by everyone else. So I held on to it and bought even a little bit more, and that turned out to be the right move. The wrong move was feeling validation by someone else buying it. That was the wrong thing. The right move was to just listen to my own thought process on it and not without any bias or without anything that's outside extraneous forces that are putting impressions on what I'm thinking. You don't want to have people like Bill Ackman determine whether or not you're bullish on a company, because you'll be bag holding companies like Nike. You'll be lost at sea with Netflix. You'll just be in situations where it's tough, because if you built your reliance on them and then they sell the stock or they do something different, that's that. And that's where your reliance is. That's where your conviction comes from. So I don't build conviction on other people. I don't recommend anyone build conviction on other people. I recommend what you do is look at other investors for information. So if you're looking at what I'm doing, I give you a lot of information. I give you my viewpoints, my arguments, my counter arguments. I show different data. I give you ideas and thought generation all the time. And I think for the most part, they're pretty good. But what I don't want, I do want you to take those ideas and look at them and consider them, and then take other people's ideas as well. Look at those and consider them and come to your own conclusion. And that's exactly what I do with people like Bill Ackman and different investors. I look at their arguments, I consider them, I look at counter arguments, and then I make my best judgment. And so I think that's the best way, because then you build your own conviction, your own thought process on a stock. You'll know when to hold it, when to sell it. You'll know when you're over your skis or you're out of your depth, so to speak, with a stock. You'll have that feeling of, I don't know what I'm doing here. And so if you have that feeling, you're doing something wrong. If you have the feeling that you're very confident in your holdings because you studied them, you very much understand the company, you have a lot better outcomes and you'll probably hold companies a lot longer. So there's my thought process on it. In summary, I really think that Bill Ackman's an awesome investor. Like his performance speaks for itself. He has great performance. When you look at his funds, netting out fees, they're really good. So I am excited that he bought the company, but that's about it. It doesn't change my view on Meta. I'm not extra secure feeling with Meta because he bought it. I just think it's a cool thing. All right, let's go ahead and move on. We'll jump into Netflix. Let's talk about Netflix for a little bit here. Netflix is down about 4% on the day, which is the next leg down to this ongoing sell-off in Netflix. So Netflix peaked at around, 130, 135, and currently it's trading around 70, 80. So it's around 50% down from the highs. That's around 50%. So it peaked out, gone down maybe 50%, and it's on a strong downward trajectory. So momentum is headed downwards. I think that Netflix going below $80 per share, I think it goes down to the low 70s. I think $70 a share is where we're headed. And I'll give you a couple reasons why. One of them is that Netflix is a cash flow machine, producing $10 to $12 billion of cash flow per year, and that's going up all the time. Their margins are going up all the time. The company fundamentally looks great. The problem is they used to be able to do buybacks, but unfortunately, with this selling pressure, there's no buying pressure. Netflix is not buying back shares. Why are they not buying back shares when they're producing tons of cash? Well, they're not because they're saving up money for the acquisition. So normally when the stock price is going down, Netflix is like, let's buy back billions of dollars per share every single quarter. Those billions of dollars help push the stock price up by reducing and retiring a lot of the shares. That's a wonderful thing for the investor. That's not happening. There's just selling pressure. There's not Netflix as a big buyer buying billions of dollars of the stock. So that's one reason that we don't have the level of support we normally do. Now, that's a choice. Again, that money is just headed to the cash balance at Netflix. So as we look at the quarters, their cash balance is going to go up dramatically because they're just pocketing all that money. They're just saving it all for this acquisition. If it goes through, they'll have a ton of money to be able to instantly pay down some of it. And then the other thing is the acquisition itself. Acquisitions of any kind that are very large always have downward pressure on a stock, especially this one that has there's so many people that want Warner Bros. We have Paramount and we have activist investors involved. We have a lot of uncertainty, regulatory uncertainty, and that makes it so that investors are just squeamish about the situation. And it also puts Netflix in this category of being considered a dead stock, which means it's just dead money. It's going to float around for the next year and a half before it starts having any stabilized trend again. So when a stock is considered dead money, investors sell out because time is money and money is time, and we're going to take it out of Netflix and put it into something else that has momentum. It's going up today. Investors want stocks that will go up this year. We have fund managers that if they don't get 10% performance this year, they're going to lose their job. So waiting around 5 years for Netflix to perform, that's out of the question. They're not going to do that. They're selling Netflix today. They're putting it in something that is going up and to the right. So you have the dead money problem with the acquisition. You have the no buyback problem, no buying pressure when they're selling. And then you have a third concern, and that is the rapid advancement in AI video content. So there's a new model, AI model that basically I think it's done by ByteDance, where ByteDance, which is a Chinese company, of course they're competing with these models just like Gemini and OpenAI, but they trained their model on enormous amounts of video footage. And what it looks like to me is they obviously violated a bunch of laws. They trained on all copyrighted data, like many of these AI companies are doing. Like, all these AI companies are probably training on lots of copyrighted data. But in any case, this is just so obvious because it's video footage. And what they've done is they've trained on lots of Hollywood movies, lots of Hollywood TV series and, big time TV series and stuff, and made a video model that is pretty impressive. Let's go ahead and just play some of this. Okay, so here's one that's being passed around. Let me play this. Pretty good, right? I mean, this doesn't look too bad. It's blown up. The video is not the highest resolution, so it's blown up a little bit. But again, it's cool setting. And we're looking at, who are we looking at here? We're looking at Tom Cruise. To me, that's Tom Cruise. If that was in an official movie trailer, I'd have no clue that that's AI. Just none. It's indistinguishable. That is Tom Cruise, as far as I can tell. That's his image, perfectly replicated. Then we also have Brad Pitt. I can't get a good free. This moves so fast. That's him. It looks just like I can't tell. It looks close enough like him, and even the fighting doesn't look too bad. It looks pretty good. It's probably not the best choreographed. It seems like they took one style, these really sharp hits, and just did that. But that is entirely AI generated. Now another one here, and this one is I think even more crazy to me because it's ultra close up. And typically when you have ultra close up, it just doesn't. It has that AI look. We know the AI look. It looks overly brushed, like a canvas painting. That's what AI looks like, almost like a video game. Like a really high-end video game. This doesn't look like that. This just looks like a close-up shot. Breaking Bad, you have it right here. Look, let's take a look.
You think you're in control. Control? You're not.
Okay. That is not a close resemblance to his voice. That's his voice. It's AI, but the fidelity is so high to his actual voice. To me, it just sounds perfect. That sounds exactly like him. Even the kind of the guttural noise at the end, it matches him perfectly. Let's go ahead and look at another one here. And these just came about with this latest model. Here, let's go ahead and watch some Seinfeld. Take a look here. Let me bring it in at the beginning here.
You know, that was completely uncalled for.
That's Jerry. Obviously, George isn't kicking people through walls, so that's a little different. But it looks like George, it looks like Jerry, and then his voice, obviously that's completely uncalled for. George, it sounds just like him. It sounds perfect. This isn't impression quality. This is 100% fidelity.
You know, that was completely uncalled for.
All the tonations, the exact voice. And this is why I say that it's obviously 100% trained on every single Seinfeld episode. They put that into the model so it can just take the voice and perfectly replicate it at this point. But I'm looking at this thinking, wow, this is really intense. Like, this is a dramatic increase in the quality. It's a dramatic increase in the quality and the scope and the range of what it's able to create in a very short amount of time. Here's another one, and I'll give you full screen on this so you can see this one. And they share the prompts for these. It's like make a samurai futuristic sunset battle in the desert, and then it creates something like this. It's pretty cool. I'll be honest here. This is one of my favorite. I'm a sucker for this type of stuff. Like, I'm a little kid at heart. When I see two guys in the desert they're using awesome, like, almost lit up blades that are samurai swords to fight each other. I loved Dune, so this was obviously trained on Dune. It has the same exact cinematic look, but it just looks awesome and it looks real. It's pretty good. All of these are pretty good, and there's more and more of them. It's past the point of a funny thing that you can just scoff at and go, oh, these videos, they're all right, but that doesn't look like quality. That's not prime time. To where you're going, these look like they could be in a high-end movie, not even a TV series. They could be in a movie. They're passable for movie level. And then just as a display of the advancement of it, you have the Will Smith eating spaghetti, which I don't know why he's always eating spaghetti. I don't know where that originated from, but that's just kind of the meme at this point. And but I don't know. Nothing against it. I love spaghetti, so I make it all the time. But here we have Will Smith eating a big old bowl of pasta spaghetti. Let's go ahead and take a look at this. This is the latest iteration.
That's the good stuff. And that's a wrap.
Does that not look real? It looks real. It's a little bit gross sounding watching someone eat this close, but look how real it looks.
That's the good stuff. And that's a wrap.
I'm having a difficult time here. Will Smith could have just filmed this and I wouldn't be able to tell. Maybe if it was ultra high resolution, on the resolution it looks so real to me that I can't really tell. I think you'd have to do one of those where you're looking at the video and analyzing every single detail. And then they get even crazier. So for example, after someone created the Tom Cruise, Brad Pitt fist fight, someone else created it, but this time it's a bit different. Listen to what Brad Pitt says here, okay? And just think, would Brad Pitt be happy to know that there's a video that looks 100% real of him saying this?
You killed Jeffrey Epstein, you animal! He was a good man!
He knew too much about our Russia operations. He had to die, and now you die too.
He just called Jeffrey Epstein a good guy. And this looks 100% real. Now, and even the close-up, it looks so good. So if we zoom in here, this looks crazy realistic. Like it looks like it's a trailer for a movie. Even the wounds look crazy realistic. But then he's saying that, you've got Brad Pitt saying Jeffrey Epstein. This is the stuff that I think is going to infuriate Hollywood. And there's some groups that don't have a lot of political influence. There's some groups, if you infuriate like farmers, they'll go and they'll protest and they might go on strike or something or whatever. Hollywood, though, they're the ones that with the big, they have a lot of connections. They have a lot of political influence. They're the ones with the big microphone, right? They can make a lot of noise. You think when people like Brad Pitt see videos of himself that are 100% real looking, where he's calling Jeffrey Epstein a good guy, do you think that he's going to enjoy seeing that? It's going to make them furious. This is part of what I see going on right now. We're at a situation where these videos look so real and the potential damage that can be done from them is so extreme. You could train all my YouTube videos. If someone could run it through all my YouTube videos of my podcast, they'd learn my voice, it would learn my intonations, it would learn my facial features, and then you could make a stupid video saying whatever, anything, the worst thing imaginable, the worst slurs or whatever. You could make any video whatsoever to try to destroy someone's reputation, to try to endorse something that they're not endorsing, to try to scam people. It's a serious problem, the power of these models to be able to mimic someone, steal their identity, and then use it to create stuff like this. So I think that what my first reaction seeing this is they're going to get sued into oblivion and banned and laws made if they allow this to happen for any amount of time. I think that this whole thing where you're taking celebrities is going to be shut down real fast. That's the first thing. The second thing is looking at this through the lens of what type of companies it impacts. I think that part of the reason Netflix is down today is because of this, is because Netflix investors are trying to put in a framework of what does this do with Netflix's content. So when I look at Netflix's content, I believe that this type of stuff competes with, first of all, I think kids content like animated series, Disney's, kids series, all those type of ones where it's just animated characters on a screen. I think that stuff is going to essentially be zero cost to make. So when you go to a library like Disney Plus, Paramount Plus, Netflix, and you go to the kids, the animated stuff, that's basically free. Every company is going to have an infinite amount of that. It's going to be fully automated. They'll be able to just make a kids show in 2 seconds because kids shows are just about the visuals and having clean visuals. They're not complex stories. They have very simple plot structures. So those ones, I think the content cost for making those is already very low, but I think that goes to zero. I also think that this is also going to make it so that there's more interesting videos on TikTok, more interesting videos on Instagram Reels and YouTube Shorts. So I think that the competing platforms against Netflix will have more dynamic and interesting videos on it, which does represent a threat to Netflix. I think that, though, this type of stuff is not going to replace the want to have a well-constructed, well-acted, well-produced, fully fledged TV series. I don't think it's going to replace that. So if you have like a big show, Pluribus, or you have Game of Thrones, or you have like The Sopranos, or you have a comedy ensemble, you're not going to have all that be replaced by these AI created things. And it's especially going to be more difficult to replace them when laws and regulations get in place that make it so that they can't rip off Hollywood actors. So there's going to be no-name people in them. You won't have the same actors. They'll protect their image. What I believe will happen is Netflix is likely to use tools like this to bring down the cost of very specific parts of a movie. So if there's a movie that has a big explosion or a car explodes, they probably don't need to go and blow up a car. They can probably do that with AI. They can probably make one aspect of it or make the explosion a little bit more impressive with AI that otherwise would have cost them production and money, and they had to go find a car to blow up, right? Movie studios used to do all that stuff, and I think a lot of that is going to be done digitally and in a way that you can't tell the difference. So I think it will actually enhance Netflix so that Netflix can save money on content production. They can save money on specifically the CGI portion of content production, the physical like explosives and stuff like that, the effects part of content production. I think they'll be able to save money on that and then reroute that money to marketing and distribution so that they can create more series at a cheaper cost that are higher quality, and then they can route more money to marketing to be able to spread that online and get people excited and hyped about it, and then people can have a shared experience watching these movies. Typically, when something makes something cheaper, the gains of it aggregate to the biggest player, to the aggregators, which is Netflix. So it's difficult right now to tell how this really materially affects Netflix, but I still think the core product, the stories, the long-term episodic series, movies need so much human interaction. I don't think you're going to be able to prompt them on a ByteDance product to make something that's a five season long series. I think we're a long ways off from that. There's also questions about how this affects Adobe and different companies. I think it's a lot more direct of a threat to something where if you can do video editing this well, it makes me believe that in the future, you will be able to do most image editing through AI, highly advanced image editing through AI. And I don't know how that affects Adobe, but it's something to keep in mind. I think that as long as these type of things are advancing, Adobe stock is going to be it's going to be very difficult to paint a very bright future for it. But we'll see. Maybe again, Adobe will grow along with it as a catalyst instead of it being displaced. I really don't know the answer to that one right now. What is your view on this low valuation Ford PE of 20? Yeah, it's like 20 on next year, 25, 24 Ford PE ratio, healthy 3% free cash flow yield. If we look at Netflix too, let me do this. I'm going to build a chart here on the charting feature, and this is going to be released hopefully this weekend. That's what we're planning for. But let's bring in Netflix and let's go revenue. Let's look at that over time. Let's take a look at operating margin. This is something that I think is worth looking at. Let me make a chart here. Okay. When we look at Netflix, let me download this real quick and so you guys can see this chart. And I'll show you how all of this works very soon. But I want to have a video where I actually go over all of it. So if we look at it here, this is what it looks like. And I just created this in like a second ago. So it's really easy to create these charts. It takes 2 seconds to do. Like I literally just did it there. This wasn't a saved one. So we look at Netflix here and we have revenue. This is on a trailing 12-month basis. And you can see the revenue growth has ebbed and flowed, but it's growing revenue over time. And then we have the operating margin in black. What you're seeing here is an incredibly good story of a company. Like, look at this. Operating margins went from 5% to 30%, while revenue went from $7 billion trailing to $45 billion trailing. This is incredible revenue growth with margin expanding. And those are basically all you can ask for with a company. With any company, you want operating margins to go up as revenue grows. The company's higher margins and growing, which means that profits are growing even faster. So if I brought up free cash flow, it would be growing even faster. Operating margin has increased by 712% over the past decade, and revenue has increased by 530%. So 5x growth in revenue, 7 times 700% growth in operating margins. The company that's doing this while growing, if we look at Netflix and we look at the past 1 year, while growing 16% per year and growing its operating margins, is currently being liquidated. It's selling for 25 forward PE. In my opinion, I think that Netflix is cheap. I think that it's a good buy today. I think it's going to be a company that's around for a long period of time, generating enormous amounts of cash flows. When I look at the free cash flow, you see with those operating margins going up, you see the free cash flow. And Netflix has the added benefit. So many companies have that Trojan horse where you got the free cash flow, right? That's the horse. And then inside you have all that stock-based comp that spoils it. Free cash flow and stock-based comp, barely any. $360 million of stock-based comp. So there's no Trojan horse here. It's just Netflix generating free cash flow, which means that they can return it back to the shareholder. But again, they're not doing that right now. That's part of the reason the stock is going down. Netflix could be aggressively reducing their share count, but they want to save money for this acquisition. So I am bullish on Netflix. I will be buying more if it continues to go down, which it looks like it will. And I think there's potential upsides. For one, if the deal goes through with Warner Bros., I think that Netflix is much stronger. Big widening of the moat. It's going to be even harder for AI to replace some of the key series and franchise in HBO. And then they have distribution in the box office, which again, AI can't really replace box office distribution. So they'll have that. If it doesn't go through, let's look at that scenario. If it's blocked by regulators, that's no good. Netflix loses out. But if it doesn't go through because activist investor tells Warner Bros. To buy from Paramount instead, so they cancel with Netflix, they have to pay a $5.5 billion breakup fee. I believe it's something like that. It's crazy. It's multiple billions of dollars. So Netflix would have all the money that they saved for the acquisition, plus billions of extra dollars given to them that the deal didn't go through, and the stock price would be at a low valuation, which they could immediately pour back into buybacks. So I see huge upside if the deal is actually canceled and it goes to Paramount as well, because they'll be loaded to the brim with cash. So either way, I'm very bullish on Netflix. I think it'll do great, but we'll have to see. Other than that, let's take a look at other questions. My projections going forward for Netflix in terms of earnings per share and free cash flow. Yeah, I think the company can grow its earnings per share at above 20% per year because, again, Netflix always guides for operating margin expansion while having organic revenue growth. And those two things together mean big time earnings per share growth and free cash flow per share growth. Obviously, the acquisition will mess with these numbers. It'll mess with them for a year or so. That's part of why the stock is down. Let's go ahead and switch over to Meta here. Okay, so here's a good one. What do I think about the off-balance SPV financing that they've done? To me, it's just there's the big questions and there's the small questions, and this is the small question. It's just not that important, is my opinion of it. It's not that important. I don't think that this should be a defining question of whether or not you should own Meta is how their accounting structure is how they structure their accounting. It's not they're not hiding anything in terms of like this isn't like a situation where they're committing accounting fraud. What they're doing is they're just doing different accounting structures. One auditor said, "Hey, this is something to look at. That this is in the right category." Companies do this stuff all the time. So, for example, Uber, to make it so that they have higher margins, they make it so that their company that manages fleets is actually like a different company. So they keep all that low margin stuff off of their company profile, even though they're basically owning it and managing it. So it's basically the same type of thing. Sometimes companies, to keep their financials looking better, they'll put things in different categories or do different things to keep it off the balance sheet. And that's illegal. It's just if it's done correctly, which auditors are looking at. In my opinion, again, it's like a sideline. The big question is for Meta, is the moat getting stronger? Is the earnings power still good? Will they get a high return on their CapEx build? Does Meta have a bright future over the next 10 years with all their supercomputing power? Or are they becoming a very low margin, high CapEx utility company that has low margins and is not profitable? Those are the big questions. This thing of the SPV financing is not a big question. Is there something that's stopping you from buying more Microsoft? Would also love to hear how you see Intuit playing out. Yeah, Microsoft, I think, just increases risk of... Microsoft is a little bit in both categories. Their software and their CapEx. So investors are scared of software and they don't like the big CapEx spend. And Microsoft is literally in both of those businesses. So I think it's a tough one to buy right now. You can buy in, but I think you're going to have a lot of pressure on Microsoft for the next year or so. For me, I like that Meta is only CapEx. They don't have the software threat. They don't have the AI Claude plugins. There's no Claude plugin to social media that makes it so your social media is way better. It's just Meta has full control of their own destiny right now. That's why I feel like Meta just has one of those risks, which is CapEx. They don't have the Claude AI threat mix. Let's go ahead and look at this one. If you can briefly go over your thoughts on Microsoft, ServiceNow, Intuit, Netflix. I still am researching Now's operating income, and it's very robust. With regards to that, what are your thoughts on the feasibility of switching costs of enterprise SaaS using AI to make new code for their internal software workflows instead of using SaaS providers like Now or CRM? Sure. So when we look at Netflix, I think I've shared my thoughts on that. I'm bullish on Netflix, but I expect like a dead year. This is, by the way, I don't think that 2026 is going to be my year. I just don't think it is. All the companies that I'm in, they all have stories that are wait and see for a year. We have acquisitions. We have AI advancing with many software companies. Now we have S&P Global and Moody's that need to prove themselves. We have Meta with huge CapEx and Google that's already gone up. So, and ASML that's already gone up. So for me, I think it's going to be a rough year. Just being honest, I don't think that this is going to be some banger year for me. That's my prediction right now. Usually I'm more optimistic at the beginning of the year, but right now I feel we're just going to have to hang in there. This isn't my year, but I refuse to just change everything. And I'm not going to be going in and buying Walmart and Delta Airlines. I'm staying where I think I'm going to have the best returns for the next 10 years, not where I think I'll have the best returns for 2026. Last year was good. My one portfolio was up like 19%. One was up a little bit of 20%. Last year was good. This year we're off to a rough start, down 6-7% right now, maybe a little bit more today. So again, 2026 is looking bleak so far, but I feel good about the companies that I own. But now looking at Netflix, I think that one's good. Intuit is a company that I'm constantly doing analysis on. It's still growing fast, and let me put it this way. If Intuit is donezo, if Intuit is done because of AI, like every software company's done, Intuit has such market dominance over the categories that they operate in. They're small business accounting. They're individual tax. And they've faced free competitors, government-sponsored competitors. They've faced other companies working overtime to create competing software that's free. And they haven't gotten any advantage over Intuit. Intuit's faced off against Microsoft, creating their own accounting software, creating their own tax solutions. None of them have won. Intuit has been an absolute beast for the past 20 years. They just do their things and they do it so well and nobody else can gain any advantage. So if AI comes in and disintermediates and disenfranchises Intuit and their supremacy, SaaS is just cooked at that point. The whole category is done. Like it's gonna kill everything. So I'm fine holding Intuit and knowing that if that one is truly done, that I feel like the whole category is dead, and that's my exposure to it. I don't have much exposure to pure SaaS beyond Intuit. S&P Global and Moody's are half and half SaaS. They're not even full SaaS. They're mostly government-regulated stuff. And then Microsoft, of course, has the gigantic Azure business, and then they have some SaaS exposure, but they're like in video games and stuff. So I feel like Intuit is my only pure play SaaS company, and it's a very good one. And I'm going to hold on to it because if I sell out of that, I'm basically saying I think all SaaS is just not the place to be. I think it's completely done. And I don't really believe that. I think it's going to be a lot more nuanced. Now, we have ServiceNow, which out of these companies, I think that ServiceNow and Intuit are probably the widest moat. When I look at ServiceNow from my research, and I looked at this while I was looking at Salesforce, I think it has a bigger moat than Salesforce. Because when companies use it, it becomes so deeply embedded that their retention rate, like, they never leave. It becomes such a part of their critical workflow that they never leave. That's why they have a 98% retention. So it's incredibly streamlined. And also Salesforce has a lot of like bolt-on products. Like Salesforce is always duct taping new products onto their suite. ServiceNow builds out from internally and expands their products internally. So all of them have seamless integration. They're built by the same teams. And I think that's an advantage as well. The downside is ServiceNow is super expensive. Let's go ahead and take a look at it. If I'm not mistaken, let me take a look. Maybe I'll eat my words here. Yeah, we look at ServiceNow, and do you see the problem here? And this is a problem with Intuit as well. This is a problem with these software companies. Again, this is a nice lesson here. Let's look at Netflix. Netflix has a forward PE of 25, and let's go and take a look at how much of that is stock-based comp. We know that with Netflix, right, that only 300 million. So you look at the stock-based comp, and it's a tiny proportion, almost none of it. If we put it in actual terms here, it's 4% of their cash flows. If we look at Intuit, this is one of those ones where the forward PE is not adjusted for stock-based comp. And that's why the trailing PE, which is a GAAP metric, forward PE is non-GAAP, and that's how the industry does it. That's how analysts do it. That's why we resemble it in Qualtrim. But the forward PE is non-GAAP, which is good in most situations, except for some software companies like Intuit and ServiceNow. They do not include stock-based comp as an expense in their forward PE guidance. So you look at Intuit, or I think we're looking at Intuit, yes. And Intuit has this much. Let's zoom in so you can see this easier. Okay, so there we have it. Around 40% of the cash flows they generate are also being actively diluted by stock-based comp. So that makes it the company look artificially cheaper on a forward PE basis than it actually is, because 31% of it is through stock-based comp. You can also look at the same thing here with ServiceNow. And this is what it's not a killer, but it's just something you have to pay attention to. With ServiceNow, it's a low PE ratio, but look at the trailing PE. It's a trailing PE of 60, because again, the trailing PE factors in stock-based comp, the forward PE, they're not. And this is a company by company thing. Google factors it in. This is 43% of their cash flows. So you look at their free cash flow and you go, wow, that's really good. The free cash flow is going up in total, but then you look at the free cash flow and stock-based comp, and you notice their stock-based comp just grows like crazy. It's nearly 50%, and it's growing fast. The company is not as cheap. It's just not as cheap. Let's take a look. When we look at Meta, okay, so take a look at this. We have forward PE of ServiceNow at a 24. Let's see if they include... Does ServiceNow include stock-based comp and forward PE guidance? They do not. So ServiceNow, this PE ratio of 24 does not include that extra expense, which is 40% stock-based comp. So another way of looking at that is you can somewhat add on 40% to this PE ratio. It's closer to looking like the trailing one. It's probably like 50, 45, 50. I can Google it right now. What is ServiceNow PE if you added, what is ServiceNow forward? Let's see if Google has this. Non-GAAP. The PE removes, if you treated stock-based comp like an expense, GAAP-like on a forward basis, then it goes to roughly 50 to 60 times range. So here's a conundrum. You might ask, why don't I make it so that forward PE is GAAP? Because in most cases, it's good that it's not GAAP, because non-GAAP doesn't include investment gains, things like SpaceX or Waymo, one-time tax hits. It normalizes it in a good way in most situations where there's just a one-time expense. But some companies, they say, hey, let's just treat stock-based comp like an ongoing one-time expense instead of just an operational expense. And that's just wrong. These companies should be treating it as an ongoing operational expense that's treated as an expense in their forward PE guidance. So this really should be more like 50 times forward earnings, because they cannot get rid of stock-based comp. They can't. If they fire these people, their company goes to zero. They have no talent. That's the way they're compensating their employees, is by this $2 billion of stock-based comp. When you factor that in, it is 50 times forward earnings. Now compare that to Google. Google has stock-based comp. Okay, so if we go to Google, Google has stock-based comp that makes up a lot, but Google includes stock-based comp as an expense in their forward PE guidance. So their forward PE is only 27 with all of that already factored in. But they exclude SpaceX gains or whatever gains from investment gains. That's why I like the forward PE on Google. With Meta is another company that does have stock-based comp expense. So we can look at it here. Their free cash flow and stock-based comp, right? They have a lot of it. Meta includes that as an expense in their forward PE. So they're at a 22 forward PE with all that stock-based comp expense included. So do you see the difference there? Basically, what I'm saying is when I look at these companies, I think that ServiceNow looks a lot more artificially cheap than it actually is, because when you exclude such a dramatically huge expense as stock-based comp, it just gives a different picture of the company. If Meta, I wonder what it would be. Let me ask this question. What would Meta forward PE be if you excluded stock-based comp as an expense? Let's see. It'd be about 18 times, 16 to 18. So if you had the forward PE, and basically if you normalized Meta and ServiceNow on a forward basis, if you factored out stock-based comp on both of them, then Meta is much cheaper. ServiceNow would trade at what it does right now because it's factored out. So ServiceNow would be at a 24, and Meta would be at a 15 to 18. So Meta is at a 15 to 18 times forward PE ratio, growing 30%. When you factor in stock-based comp, Meta is at a 22, so that's realistic, and ServiceNow would be at 50. So the stock-based comp, factoring it out, does a lot more advantages for ServiceNow. It almost cuts their PE ratio in half than it does for Meta. And again, it's just something I look at. I'm looking at opportunity sets here. I don't know why I would buy ServiceNow, which it's growing all right, but it's growing slower than Meta. It's in that category where I do think that there's some threat to the business model, limited, but I think there is some. And you have Meta that's trading at half the PE ratio when you are factoring in stock-based comp. I just think it's a better deal. I do think that ServiceNow will be okay, though. I don't see a lot of disruption happening. And then Microsoft, I think Microsoft's fine. It's going to go through a rough year. I believe they're in the category of the two hated halves of large CapEx spend as well as being in software. So that's going to be tough for Microsoft. So I think it's fine if you want to accumulate shares. Just believe that Microsoft's going to take a year or two until the magic is back in the stock. Let's see. So do you think it's likely Meta grows their family of apps revenue to surpass Google search in the next 5 years? Oh, I don't know. I'm not really comparing them side by side. I think that Google is a superior company to to Meta overall. Google has like Waymo and YouTube and cloud and all these great businesses and Gemini model. Meta is behind on a lot of these things, but I think that Meta has a very good thing going. And I could see the gap in their valuation coming closer if Meta maintains its fast revenue growth rate. Because even though Meta, I think, is an inferior company to Google in a number of ways, it is growing twice as fast. And that does make up for the lack of diversification and lack of great businesses. What do you think of the ton of countries banning social media for teens in terms of the effect on Meta? I'm in support of them banning social media apps for teens up to a certain extent. I think when you're 16, 17 years or older, when you're becoming an adult, I think you can get social media. But I'd never let my kids have an Instagram account. I'd rather, oh my gosh, there's so many things I'd rather them have than Instagram as little kids. And I think it's so destructive to have little kids, have access to apps like that. I think it's terrible for them psychologically, terrible for the relationships. It's just not good overall. I'd rather them play video games and go out, go do social things outside, even social things where you're doing them together, than just scrolling Instagram and looking at all the garbage filth that's just spread one swipe after another, sending you down some algorithm. It's the same thing. I don't want my kids on Reddit ever. Like they're never gonna be on Reddit growing up. They can discover that stuff and use it when they're adults and they've already had they've been raised really well and they're well prepared to take on challenges in life. But they're not gonna have exposure to all these social media platforms growing up. I also don't think that that's a super damaging thing to the business model of Meta. I don't think teens are spending lots of money and the primary drivers of revenue growth for Meta. There's a thought that if you don't start as a teen, you'll never use social media. I don't buy that. People switch social media platforms mid-life. People are using platforms they've never used before. They change all the time, so I don't think that's going to be a problem. Geopolitical risks. There's always going to be lots of articles of people upset at Meta, lots of regulations. I already know that. That's already well baked into the price as well. Concerns about powering all these power centers, all these data centers and computational power, like where do they get the energy? I think that's part of the land grab, is acquiring that energy is going to be a strategic benefit. They've already talked about that. So the reason they're moving so fast and aggressive and putting down so much money this year is that land grab. To say we're going to get the rights to all these energy, we're going to get the land, we're going to get the territory, because it's going to get even more expensive later on, and we'll have this land to begin with. So I think that moving fast is part of the calculation. We have Stitch here saying, "Hey Joseph, thank you again for all the amazing content and the hard work you put into your videos. I'm learning more and more each video." I'm happy to hear that. Could you elaborate on your decision to sell companies like Salesforce, especially when you've mentioned that their financial performance and growth metrics are moving in the right direction? I'm trying to better understand the role sentiment plays in your investment decisions. My understanding has always been that investors should prioritize business fundamentals over short-term market sentiment. If a company appears to be moving in the right direction operationally, financially, what factors would justify exiting a position? How do you balance fundamentals versus market sentiment when making sell decisions? Okay, so yeah, I can go over this in a couple different ways. So one of them is every company that I buy on the whole is probably going to be a decent company with solid fundamentals. That's like the number one thing I look for. Typically, companies that have very strong moats and solid fundamentals, typically they'll usually move in a solid direction, in a positive direction over time. And then after I buy them, I'm not done doing research. I'm constantly looking at them, evaluating them, looking at their progress, looking at potential risks or anything that I may have missed in my analysis. And in many cases, the companies that I sell remain good companies after I sell them. That was the case with Booking Holdings. It's a great company, and I sold it. I sold it for various reasons at the time, but I made money on it. It was a great company, and I sold it. Apple, today's a great company, and I sold it. Made $30,000, $40,000 on that one. I would have made more if I had more money to invest at the beginning of my investing journey, but in any regard, I sold it for a profit. And there's been many companies. I have over $150,000 in net gains from all my sales. So the companies that I'm exiting at a profit. And then most of those companies, after I sold them, continue to do okay. They'll continue to compound. They might go through droughts for a while. Like I sold Chipotle at a profit, and that one went down afterwards. That was one that I was happy I sold before Bill Ackman. I sold it at a much higher price than him, I think 30% higher. So I feel good about my timing on selling Chipotle. In any regard, though, when I'm looking at a company, the biggest thing that I'm looking at is if the fundamental moat and future predictability of the company is becoming increasingly better or increasingly worse. Meaning, is the company becoming wider moat and more predictable, or more narrow moat, questionable and risky? When I looked at a company like Google, when I was buying into Google, there was ChatGPT, which made it feel like it was becoming more risky and less of a moat. But as I looked at it more closely and I looked at the plans that Google is doing, I realized that overall their moat is still very wide. And in fact, in a lot of ways, it's getting wider. For one, they own YouTube and cloud, which are things that ChatGPT could not get. They kept Chrome, which is a moat stabilizing event. They had Gemini models come out, and they have massive distribution, which I believe actually increased the moat. The management said repeatedly that the organic search was growing, which I think increases the moat. So my thought was, even given the challenges, I actually think that Google's moat's getting wider, and the company will trade up in valuation. We also have like ASML, which the company moat is getting wider. We also have Netflix, which the company moat I think is getting wider. We have Amazon, which the company moat's getting wider. Then we have companies that I was questioning if the moat was actually being decayed and the core business is being decayed. When I looked at companies like Adobe and Salesforce, what I saw is a true threat of their core business model, of their core product, a true threat and a decay in their moat. So for Salesforce, the moat is like high switching costs, it's compliance, it's trust. The people are going to build on Salesforce, they're going to use it. But what's changed is, first of all, companies that sign up for Salesforce have like a big frustration with it, that it's very expensive. That's the common frustration with Salesforce all the time. And I remember that at the companies that I've worked at, Salesforce is always trying to negotiate licenses with higher costs. You're always trying to get them down. They're always trying to sign you up for new products. You're always trying to, it's just a battle of getting that license down to a more affordable arrangement. So there's cost pressure with all the businesses they're doing business with. There's all the sales guys trying to sell it for more. And Salesforce needs to keep the amount of seats. They need to increase the price. They need to have add-ons. They need to do all these things to grow. Meanwhile, there's AI that's threatening to do many of the things that Salesforce does for a fraction of the cost. So like ticket automation, responding to customers, like all this type of stuff. Like there's different applications coming online all the time. And I think that they're a true threat to a lot of the different add-ons and services and plugins and applications and ecosystem of Salesforce. It doesn't mean that the company is going to get crushed or that revenue will stop growing, because Salesforce has their huge sales team. They'll increase licenses. They'll extract money. They'll continue to offer services. But I do think that it is a negative catalyst for the moat. I think that Salesforce is facing more competition, more options, a harder time with their pricing power than they once faced. I think more now than ever. I also believe that just in the arena of SaaS customer management software, that there's just more competition. So forget about AI. There's just more of it today. It seems like Salesforce was a lot more unique 10 years ago or 5 years ago than it is today. There's so many different things that are moving into that manage your customer category or already have substantial things in there. Even ServiceNow is moving into that category. And Salesforce it just is hard to price your product, ever-growing prices, when you have a convergence of so many competitors moving in, when you have AI making it easier to write code, when you have all these little AI startups and stuff that are eating away at the edges. I think it creates a harder environment for Salesforce. And when I'm looking at that and I'm just comparing it to Meta, Meta's growing faster. It's at a it's at a low PE. Salesforce is probably at a lower PE now, but Meta's at a low PE, growing much faster, and from my estimate, has a much wider moat. Meta has more control over their operating margins, I think, than even Salesforce does. Meta doesn't have to have a team of salespeople to continually try to renegotiate contracts and try to price it up. They have a core business that organically just produces so much money that so many different small businesses are reliant on. Meta sits in between and makes so much money that when I was looking at it and I looked at the fact that Meta was expected, they posted these incredible earnings. They're expected to grow 30% next quarter. The company, Mark Zuckerberg, seems solely focused on growing this company and competing at a global scale. And the company's trading at a 22 PE. I was just looking at both of them and I thought that Meta is a better option and I wanted to raise cash for it. So if Meta didn't exist as an option, like if Meta was always trading at a 35, then I probably would still own Salesforce. I probably wouldn't have jumped on it. If I didn't see something else that I thought was more attractive, I likely would still just be in Salesforce. Part of the reason I sell a company is when I see another situation where I think the company is as good of quality or higher quality, the moat is getting stronger in the case of Meta. I believe that the CapEx build out strengthens the moat. It doesn't weaken it. I believe that Salesforce and Adobe's moat is getting weaker. Now, the stock price may fall faster than the weakness of the moat. So the moat may be 20% weaker and the stock price is down 50%. In that case, it's more undervalued because slight moat weakness, huge drop in the stock price, maybe you'll make out well doing that. But I like it when the moat's getting stronger. With Meta, I think the moat's getting stronger and the stock price is remaining flat. It's been flat for over a year. And that was a calculation. I'm looking at opportunity sets. I don't fall in love with companies. These companies it's a team. It's a team of all-star players. It's not a family. If one of them breaks their leg, if one of them gets injured, they're off the team. No hard feelings. I'm going to bring in a new player and we're going to go forward, right? So I'm doing that. I kicked Salesforce, kicked Equifax off the team. I'm sure they'll do good. They might heal. We might see things happen in the future that are good for them. But Meta's the new teammate. That's the one where we brought in a new talent, new teammate, and I think Meta's a really good option. So that's just the way I looked at that. Let's go ahead and move on to the next one. I believe you make the best long-term stock investing content on YouTube. More of an idea than a suggestion. Combine your story fund, dividend fund into one, as it will make things simpler for the audience to see and understand the positions. I've had that suggested before. I guess I could do it. It's just not been a big priority. I don't know. I mean, I've been running it this way. I guess I could switch it, but it hasn't been something that's top of mind. What do you think is the likelihood of Duolingo succeeding in this upcoming years? And the valuation very attractive if it does succeed. So here's the challenge with Duolingo. I don't think people will make individual AIs that are better teachers in Duolingo. But I think what will happen is there's going to be a lot more learning applications and ways to learn that are enhanced by AI. The thing that I think that Duolingo has as an advantage is, I guess from the very beginning, I never believed that the reason that people are choosing Duolingo is because there's no other options that are good at teaching. I think the reason that people choose Duolingo is because it's a very refined user experience. They've really honed in on the user experience. They made it an enjoyable app to use. It has lots of things to keep you motivated to learn every day and keep on task. It's fun to keep streaks and to compete and have a little ladder that you compete with your friends. And even though another company can do that, when there's lots of companies doing the same thing, so it's a commodity, lots of companies competing in the same arena, the one that has the best user experience will have exponential acquisition of user over the other alternatives. Because if all else is equal, why would you choose any other than the very best? So as long as Duolingo has the best user experience, meaning the best app experience, tracking your learning, keeping you motivated, the best animations, the best feelings when you use it, the best time, as long as they have that more than anyone else, some other ones will gain some popularity. They'll have a couple million users here and there. but Duolingo will have the overwhelming exponential growth. And I'd say it's very similar to the thesis on Spotify. Spotify is not successful because it's cheaper than any other alternative. Spotify does not have an exclusive library of content. In fact, Spotify's content is exactly the same for every other music service. You can go to any music service and get the entire library that Spotify has. So there's no differentiation between content on Spotify. The reason Spotify has 700 million monthly active users is because they have a slightly better user experience than every other platform. So they get the exponential acquisition of customers. And that's the goal with Duolingo, that they can create a platform that's a bit better than all the alternatives. When users are making their judgment and they're just wanting to pick a free platform, they're going to go with the one that they think is best. For most people, that'll be Duolingo, and it'll grow that way. Now, another thing to look at with Duolingo while we're on this subject is just the pricing of the stock. Okay, so it's come down from its premium valuation a long time ago, but Duolingo continues to just plummet. And I think it's getting to a point where I guess I try to make sense of it, but it's difficult to make sense of. It's being priced as though the company is being legitimately destroyed. So we look at it here, and it's down 20% since IPO. All time. It's down the lowest it's ever been. Over that time period, Duolingo has grown from $28 million in revenue to $1 billion in revenue. So it's compounding revenue at 40%. And it's subscription revenue. Like, these aren't one-time, they're not selling t-shirts. This is subscriptions. People have a subscription, just auto renews. It's good revenue, right? They can cancel easily, but it's good revenue. And we see this subscription revenue is $805 million. So the 90% of the revenue is from subscriptions. Daily active users are growing 35%. Monthly active users, 20% year over year. Paid subscribers, 33%. We have, ignore the net income. That was a one-time tax thing. We have the free cash flow. If we look at the free cash flow, check out this. It grew by 55%. Now, they do have a lot of stock-based comp because it's a small company, but their stock-based comp isn't growing that fast. By that, I mean, in the past year, stock-based comp grew 24%, but the free cash flow grew 55%. So free cash flow is growing at a much higher rate than the stock-based comp. And if you look at the free cash flow adjusted for stock-based comp, they make about $220 million. So we have a company that is at a $5 billion market cap, $1 billion of cash on hand, that makes $200 million per year in free cash flow adjusted for stock-based comp. To me, it's an attractive situation. It's one where if Duolingo succeeds, there will be very high upside in it. But again, it all comes back to that big if the company is going to succeed. They have to prove it with the numbers. I think, in my opinion, I'm holding on to my shares. I'll write it down. I'm prepared to lose the 20,000 or what have you on Duolingo, but I'm gonna hold on to this one because I like the fundamentals. I like the numbers. I'm under the thought process that I think AI is not the reason. People don't learn languages because AI hasn't translated them. People learn them for self-fulfilling reasons. It's the same thing. Like, why do people play chess? Computers are better at chess than any human. Why do millions of people still learn chess? It's because they want to. People want to learn languages. They don't want a robot to do everything in their life. I don't. I know. I practice math sometimes. Sometimes I'll just open up the math course and do those for fun. And it's just enjoyable to actually do something yourself, even though a calculator can do math, right? Soon AI will be able to do everything. So should we just stop learning anything? That doesn't seem like a healthy way to go. So I think there's going to be a lot of people that still have the desire to learn things like communication and languages and history and different things that a computer can technically do better. So I don't look at language as just a utility. It's a thing that a lot of people do as a hobby. Let's do maybe one more question and then we'll call it there. Hope you and your family are doing well and that the new house is treating you right. Hard to believe it's already been a few months. Hopefully it stays problem-free for a long time. Yes, it's been great. It's been really good. We got moved in. The studio's great. Yeah, life's okay. When are we getting the 2025 channel analytics? Oh yeah, I've been wanting to do that. To be honest, I feel like I've just been so much more pissy over the past couple of months than usual. The channel analytics are amazing though. I should do a business update because the KPIs of the Joseph Carlson show are very, very good. Watch time is through the roof. The videos are getting 150, 200, 300,000 views with long watch times. Engagement super high. The number, some videos are getting 5,000 plus comments. That's crazy. The podcast form of the video is going through the roof. We have a record high numbers on that, and listeners, it's like 5 to 10,000 now. So we have a pretty big audience on just podcast. The Discord community is growing. I think it's better moderated than it's ever been before. There's less contention, less spam. There's less problems with it. Qualtrim, the numbers are crazy. I think we're getting close to 13,000 active paying members. Some websites, some of them will say, we have 300,000 users or 500,000 users. Those include free users. That is a vanity metric. Okay, if I just said anybody that's ever signed up for Qualtrim or anybody that's ever visited the website, right? If you have a free tier with limited features, that is a vanity metric. The real metric is how many paying members you have. We have over 12,000 paying members in Qualtrim that have already paid, and it's growing 500 per month, 1,000 per month. It's been really crazy. The move to signing up directly on Qualtrim.com has been a huge catalyst. We've had so many more people sign up. I have a dedicated customer service team, which is nice. I have expanded the development team. We're launching a new product, which is the advanced charting tool this weekend. And then we have more things lined up. I have other things that are in the works today as well that are very exciting, that I think will make very unique and compelling value for Qualtrim as well. So I'll get you the metrics at some point when it cools down a little bit. But it's incredible. I can't complain about any of that. It's been going incredible. I'm thankful for all of you being here. Appreciate it. I'll have more exclusives and deep dives in the future.